I describe the exemptions from capital gains tax when you come to sell your silver and gold. It's important to know about these rules when building your stack so that you can make sure that you accumulate the right type of bullion. You don't want to lose 18 or 24% of your gains because you bought the wrong bullion. Here I discuss what I have found. Hello everyone and welcome to Sound Money Stacking, where I help newcomers to precious metals navigate the best ways to buy and sell silver and gold. I also share some inspiration for collectible silver and discuss the markets and investments too. I recently posted a video, numbered 18 on my channel, that's all about how to avoid the taxes you face when buying or selling silver in the UK. Similar issues are faced in other countries, so look up your own local tax laws and exemptions. I should be clear from the outset that I'm not a licensed financial advisor or tax lawyer. This video is simply a commentary on my own understanding at this time, and it's not financial advice. Always seek professional advice with your investments. Tax laws are always subject to change. In the previous video, I described the exemptions from capital gains tax when you come to sell your silver and gold. It's important to know about these rules when building your stack so that you can make sure that you accumulate the right type of bullion. You don't want to lose 18 or 24% of your gains because you bought the wrong bullion. Here I discuss what I have found. Use the video chapters to skip ahead if you want a quick answer. My previous video described 3 exemptions. Most people are familiar with the first 2, which are gold and silver coins that are minted by the Royal Mint have UK legal tender status and are therefore exempt from capital gains tax when you come to sell them. Legally, these are considered sterling currency. These coins have the monarch's effigy portrait and a denomination on them. These include gold sovereigns, Britannias and their fractions, and silver Britannias, plus a wide range of collectible bullion and proof coins. These are clearly marked as CGT exempt on dealer websites. These coins should form the core of your long-term stack. The stack that you see as your long-term hedge against inflation and currency collapse, your pension or your children's inheritance. Make it tax-free from the outset. It is unlikely that this exemption will ever be removed. This advice is very clear. However, there is a world of beautiful bullion, from big shiny bars to premium bullion, numismatics, collectibles and art pieces. Once you've owned and held silver or gold, it is common to be bitten by the bug. The question is whether you'll be punished by the taxman for owning these beautiful pieces of precious metal if and when you come to sell them. The second exemption that most people are aware of is that every adult has a £3,000 personal allowance before they pay any capital gains tax. Couples can share their allowance. Furthermore, you're exempt from paying tax on the first £6,000 of your share if you co-own a possession with other people. Depending on what other capital gains you have had, this allowance may mean that you don't need to pay any CGT when you start selling your precious metals. Most people are familiar with these 2 capital gains tax exceptions. The confusing exception is number 3. The sale or disposal of personal possessions. The gov.uk or HMRC website states that, quote, you may have to pay capital gains tax if you make a profit or gain when you sell or dispose of a personal possession for £6,000 or more, end quote. And then it goes on to list some valuable items that might fall under this description, and coins are in that list. This page is quite ambiguous though in terms of whether the £6,000 exception is per item or in total, and doesn't go into any detail on the rules affecting investment-grade bullion products. Many have interpreted that if a piece of bullion is worth less than £6,000, then the disposal is capital gains tax-free. Now that's only true in specific cases, so it's important that I update the previous video with what I've learned since making my original video. It is clear from the comments in my previous video, but also from my study of many forums, that there is a lot of confusion about the capital gains tax rules on gold and silver. I've investigated this further, and I can see why everybody's got different views. So let's take a close look at the Capital Gains Manual. We have to dive into the tax code to figure out what is exempt and what is not. Most importantly, we need to look at what is considered a chattel. The word chattel is a legal term meaning an item of tangible, movable property, something you can both touch and move. Your personal possessions will normally be chattels, including your items of household furniture, paintings, antiques, items of crockery, china, plate and silverware, your motor cars, lorries, motorcycles, and items of plant and machinery that are not permanently fixed to a building. Private cars are exempt from capital gains tax, and many other chattels that only have a limited lifespan are also exempt. These are called wasting assets. Document HS293 states that, quote, "You only need to include in your tax return any gain on the disposal of a chattel where the disposal proceeds were more than £6,000 and the chattel is not exempt from capital gains tax." End of quote. It is clear that the £6,000 exception is per chattel. So, is collectible bullion a chattel or not? Well, we know from the Capital Gains Manual with certainty that coins and banknotes, which are the currency of the issuing country, are not treated as chattels, and this is item CG76881. The manual spells out very clearly that coins are regarded as currency only if they are legal tender at the time of their acquisition or disposal. Item CG78305 states that, quote, "Coins which are currency but not sterling, for example Krugerrands, are chargeable assets." End of quote. So, capital gains tax is due on all your gains when you dispose of your coins that are considered currency overseas, regardless of their individual value. This includes the popular government coins such as American Silver Eagles, South African Krugerrands, Austrian Philharmonics, Australian Kookaburras, Kangaroos and Lunar coins, and all the wide variety of collectibles that are out there with a legal tender status in places like Malta, Samoa, Niue, for example. CG78305 clearly states that these are not chattels and CGT is due on all your capital gains. You still have your personal allowance, however, so you may never actually need to pay any capital gains tax when you sell these coins. It just depends how much you're selling it in any one year. My advice is to continue to enjoy these coins, but do not make them the bulk of your deep investment stack if you are a tax resident in the UK. Now, better news is that CG78305 also states that, quote, "Coins, including pre-1837 sovereigns, which are not legal tender, are not currency. They are chattels, and they do qualify for the chattels exemption in TCGA 92/S262, which is the £6,000 per item exception. It appears from this that you can therefore dispose of non-legal tender coins freely without worrying about capital gains tax, so long as their value is below £6,000 per chattel. So the question is what is meant by coins? Well, the Coinage Act of 1971 in the United Kingdom clearly states what coins are which are issued by the Royal Mint as money in the UK, and I think we all pretty much understand that. So UK coins produced by the Royal Mint that have gone out of circulation and are no longer legal tender will be considered as Chattels with the £6,000 per item exemption. So you just need to look up to see whether any coins you have in your collection from the UK are no longer legal tender. Now, it's not clear to me whether coins issued by other overseas governments that have ceased to be legal tender would also be considered as Chattels. Now, I expect that they would, as they do conform to the legal definition of a coin in their own countries. It is important to note that sets are to be considered as one chattel, so it might go over the £6,000 cut-off. A collection of coins or banknotes is unlikely to be regarded as a set though. However, if a collection contains examples of all the values or denominations issued in 1 year or during one reign or government, these will themselves form a set. So, the last type of investment bullion outstanding is gold and silver in non-currency formats. So this includes private minted rounds, cast and pressed bullion bars, poured bars and art pieces. Sadly, all of these will be considered chargeable assets for capital gains tax purposes. They were never coins, so no exceptions apply to them. Now, there is one grey area, and that is that of collectable poured silver and gold. You could argue that these are purchased primarily for their artistic value and rarity rather than simply their intrinsic commodity value. In such cases, they might be considered as Chattels with the £6,000 per item exclusion. It's a tricky area though, because many art bars are clearly marked with standard weights and purities on them. The taxman could easily say, look, these are investment bars, no matter what premium you paid. With the poured art pieces, you could argue around the 180% rule. If you bought and sold a precious metal art piece for greater than an 80% premium over the spot value of the metal in the piece, you could argue that the piece simply isn't just an investment bullion item. This principle is based on the definition of investment gold in the UK for VAT purposes. Investment gold is exempt from VAT sales tax if it is at least of 90% purity and does not exceed 180% of the price of the gold in the coin or bar, i.e. less than 80% premium. However, this exemption is restricted to legal tender coins that have been minted in the UK after 1800 and bars and wafers of specific weights that are accepted by the markets. I do think there's an argument that very high premium pieces are works of art and are Chattels and not chargeable assets, but this is a legal grey area. You don't really have any line in the tax code to defend that position, so I would be quite careful. So in summary, 1. The following items are free from capital gains tax in the UK. Royal Mint legal tender gold and silver coins, including gold sovereigns after 1837. These coins have the monarch's effigy portrait and a denomination on them. This includes gold sovereigns, Britannias and their fractions, and silver Britannias plus a wide range of collectible bullion and proof coins. These are clearly marked as CGT exempt on dealer websites. 2. The following items are considered Chattels and are exempt from capital gains tax if they are sold for less than £6,000 per item. Coins including pre-1837 sovereigns, which are not legal tender, are not currency. They will have been government issued legal tender coins at some point in the past. So we're talking about historic numismatic coins, not modern bullion products. Sets of non-legal tender coins sold for over £6,000 are charged capital gains tax. High premium pieces of silver or gold art, such as poured pieces, might be considered chattels if they were bought and sold for premiums greater than 80% of the intrinsic metal commodity value in the piece. You need really good record keeping, and you may still get charged capital gains tax if you're audited if the piece looks like an investment bar in disguise. 3. Capital gains tax is chargeable on all of the following items, regardless of their value. All coins that are considered currency overseas. This includes the popular government coins such as American silver eagles, South African Krugerrands, Austrian Philharmonics, Australian kookaburras, kangaroos, and lunar coins, and all of those beautiful collectibles with legal tender status in places like Malta, Samoa, Niue, for example. Capital gains tax is also chargeable on private minted rounds, cast and pressed bullion bars, and poured bars and art pieces. Well, I hope this has been useful to you. Tax avoidance is legal and sensible, and it makes sense to focus the bulk of your stack on tax-efficient bullion products. Tax evasion is illegal though, and it will catch up with you eventually. I appreciate that many stackers play the markets, buying up good value bullion and flipping it for a little bit of a profit as a side gig to supplement their income. Just be aware that the HMRC will eventually see you as a trader and will come looking for income or capital gains taxes. Paying taxes on earnings, then on your purchases, and then on the gains when you dispose of your assets really hurts. Paying any tax on buying and selling what is money is particularly egregious. I get the frustration I see in the comments when tax is discussed. However, my personal view is that if I make 3, 4 or 5-fold multiples on my precious metals thanks to just timing a bull market, I'll be happy to share some of that to help pay for the doctors, nurses and teachers and so on. The state has looked after me and my family in times of need, and I'm happy to look after it, within reason of course. Let me know what you think of the information that I've shared in the comments. Give the video a thumbs up if you've enjoyed it, and subscribe to see more helpful and informative videos from me. I've got a playlist on my channel page with many how-to videos all about the world of precious metals. Thank you for watching, and see you in the next video.